it is almost time for us to pay up for our taxes. And President Biden is proposing several tax increases, which make it more important than ever to have a strategy in place for your money. Local financial professional Jeff Bangerter is here to offer ideas on how we can prepare. Good morning, Jeff.
Good morning. Thanks for having me.
All right, so we need to try and just figure everything out. So first off, what do we need to know about President Biden's new tax plan?
Well, so officially, he hasn't released the new tax plan yet, but last Wednesday he did put out the new $2 trillion infrastructure plan. And in that, it included a 28% or 28% tax bracket for corporations. But he's also going to release a second tax program that is going to target wealthy people. Again, anybody making over $400,000 a year is going to be subject to an increase back to the 39.6% federal tax rate, which started before until the 2017 tax law changes dropped it. But so you'll be paying essentially 40%. But I always like to remind people that you're going to pay California about 10% too. So you'd be in a 50% tax bracket if you're above $400,000 of income. So it'll be an impact.
Yeah, that definitely is going to hurt a lot of people, at least from that perspective. So for raising taxes, Biden can't necessarily just raise it immediately, right? It has to go through the course. So what can we expect now that we know that there is this idea behind how we're going to pay for this infrastructure? What happens next?
Well, it has to go and get congressional approval. And there are a lot, I won't say a lot, there are a handful of Democrats that are not in favor of the plan. You know, they're concerned about it, obviously, and getting reelected. And I don't think you're going to have any Republicans support the plan either. So it might have to go through a few iterations before they get through. And a couple of things that I think most people don't really know about is like I think everybody's heard they're going to tax the people that make over 400,000, whatever their little class warfare or whatever going on there. But they have these other things about long-term capital gains. Most people don't realize. So if you have a long-term capital gain, you either pay 0, 15, or 20% now. Well, if you have over $1 million, so for instance, let's say you had a property in the Bay Area that you bought 30 years ago for $100,000 and it's worth $2 million, which is very likely. If you sell that, you're going to pay $1 million in taxes. And part of the opportunity that people have had is to be able to do a 1031 exchange with real estate where you could defer the taxes indefinitely. And it's been very important. And actually, Janet Yellen came out and said she didn't think that they should get rid of it, which is what's been the conversation, because it would be too destructive to the economy. And we do a lot of 1031 exchanges. I wrote a book about it too, actually. So if anybody wants a book about 1031 exchange, go ahead and have them hit our website. We'll help them out there. But the other one that we were talking about just before air is that most people don't realize this, but if you get an inheritance, so if mom and dad leave you stocks or a house or any of that kind of stuff, right now you get a step up in basis so that you wouldn't pay any tax on it if you sold it right after mom and dad died. They're talking about eliminating that as well. That'll hit everybody that gets an inheritance. So there's things in there that most people don't know about.
Wow. Yeah, this is something that you have to really pay attention to, especially if you have that possibility of even jumping up into that next tax bracket. But it's going to hurt, it sounds like. All right, thank you so much, Jeff Bangerter. And if you have any questions for him, make sure you head on over to his website and he'll be able to answer all your questions. Thank you. And check out that book on 1031 exchanges.
Absolutely.